In this video, we will see how bank system works. We will explore the origins and evolution of money itself. We will learn what inflation is, how it's measured. The video also sheds light on external sector dynamics. Finally, we will take an objective look at the rise of cryptocurrencies. Banks operate on a straightforward model. They take deposits from customers, which become their liabilities. They then use those deposits to make investments and give out loans, which are their assets. The idea is to generate a spread between the interest earned on assets like loans versus the interest paid on deposit liabilities. However, this model has inherent risks. Some of the loans or investments may turn into bad debts if the borrowers default. To protect customers' deposits, banks follow regulatory requirements. Statutory liquidity ratio, portion of deposits that must be invested in government securities. Cash reserve ratio, percentage of deposits that banks keep with the central bank as cash reserves. Banks also need to comply with Basel norms on capital adequacy standards. The key metric is the capital adequacy ratio or CAR. Maintaining a healthy CAR ensures banks have sufficient buffers to absorb potential losses on risky assets. A key function of bank is credit creation facilitated by the fractional reserve system. Here's how it works. The cash reserve ratio is 20% for every 1000 rupee deposit a bank receives. It must keep 200 in reserves but can lend out the remaining 800. This 800 loan becomes a new deposit when the borrower deposits it in another bank. The second bank can then lend out 640 after keeping the 20% reserve. This cycle continues, allowing an initial 1000 rupee deposit to be multiplied into a much larger final money supply through issuance of new credit. The limitation is that the money multiplier is capped by the reserve ratio. Higher reserve requirements restrict credit creation. Apart from banks, governments can directly increase the money supply through various methods. Central banks can literally print more currency notes to inject liquidity into the economy. Reserve banks prints money based on balance sheet, income, expenditure, gold reserves, and demand for paper currency in the economy. Monetary policy tools allows central banks to influence this process and control money supply in the economy. While credit helps drive economic activity, the 2008 global crisis demonstrated the risks of reckless lending practices. Subprime mortgages were repackaged into securities sold as AAA assets. When housing prices crashed, it set off a chain reaction of defaults that brought down major banks and triggered a credit crunch. To understand modern monetary systems, it's useful to look at the evolution of money over time. Barter systems involving direct exchange of goods and services paved the way for commodity monies, where items like gold, silver, shells with intrinsic value were used as mediums of exchange. This led to the minting of metallic coins with regulated weights and values that removed verification needs at every transaction. Paper currencies initially represented certifications redeemable for precious metal reserves held by issuers, but gradually transitioned to being used as principal circulating money themselves. Finally, modern economies adopted fiat money, currencies derived from sovereign decrees without commodity backing. Their values underpinned by monetary policies, economic fundamentals, and government guarantees rather than linked to any specific good. Inflation refers to the sustained increase in the overall price level of goods and services in an economy over time. The two primary causes are demand pull inflation. Too much money chasing too few goods drives up consumer demand, letting producers raise prices. Cost push inflation. When input costs like wages, raw materials, or energy rise, businesses are forced to pass on higher prices to maintain margins. Inflation is measured through price indices like Consumer Price Index, Wholesale Price Index. Consumer Price Index measures the change in retail prices paid by typical consumers for a basket of goods and services. In India, the CPI has three major groups: CPI for industrial workers, CPI for agricultural laborers, CPI for rural laborers. The Reserve Bank of India currently uses CPI inflation measures, particularly CPI combined, as the key metric for monitoring price rises and guiding monetary policy decisions. Wholesale Price Index tracks price changes of goods at the producer wholesale level before reaching retail markets. In India, WPI tracks prices for primary articles, fuel and power, manufactured products. The WPI monitors prices at the first stage of transaction, acting as a leading indicator of future retail inflation. Additionally, core inflation strips out volatile food energy components to capture the underlying trend, guiding monetary policy decisions. Unchecked high inflation erodes consumer pricing power, deters investments, causes currency devaluation, and breeds economic turmoil. So central banks aim to maintain low, stable inflation without stifling growth. Prolonged high inflation has far-reaching negative impacts across the economy, diminishes real household income and consumer spending purchasing power, increases business costs, creates operating uncertainty, deters investment as returns diminish and risk premiums rise, creates asset bubbles as investors flee currency for real estate hard assets, devalues domestic currency, hampers trade competitiveness, increases likelihood of social political instability if uncontrolled. A country's balance of payments tracks all economic transactions between residents and the rest of the world. It has two main components. Current account records state and goods, services, investment, income, and transfers. A deficit means more money is flowing out. Capital account tracks movement of capital for investments, loans, and asset transfers. A surplus means more investment flowing in. A current account deficit occurs when a country's value of imports of goods, services, investment, income exceeds the value of its exports over a given period. It represents a net outflow of domestic currency to foreign markets. India has been running current account deficits in recent years as its imports tend to outpace exports. If the Indian rupee appreciates sharply against other currencies driven by factors like high demand for Indian exports or increased foreign investment inflows, it would have the following effects given India's current account deficit situation. Indian exports become more expensive and less competitive in global markets. This could potentially reduce export volumes and earnings. Imports become relatively cheaper for Indian consumers and businesses due to the stronger rupee. So currency appreciation tends to be positive for current account surplus countries by curtailing their trade surpluses and negative for current account deficit nations. After World War II, the Bretton Woods system attempted to govern monetary relations among major industrial nations. Key features: US dollar was pegged to gold, acting as the world's reserve currency. Other currencies were pegged to the dollar at fixed exchange rates. This dollar-gold exchange standard promoted currency stability and facilitated trade. However, persistent US deficits and dollar led to pressures that collapsed the system by 1973. Countries then moved to the floating exchange rate regimes. This decoupling from gold freed the US to use monetary policy tools to manage money supply and inflation rather than being constrained by physical gold reserves. Thoughts on crypto? It's against the interest of federal banks. They make the rules and crypto is a threat to their control. I just don't think they will let it succeed in the long run. Another thing that bothers me is that crypto feels like just another Ponzi scheme for the rich to get richer. It's not a level playing field. Don't get me wrong, the technology behind crypto is amazing, but as an investment, I think it's a bad idea. It's no different than collecting Pokemon cards. Just because it's rare, it doesn't mean it's valuable. The value of crypto depends on demand and supply, which is a fragile foundation. If demand drops, the value plummets. It's just not a stable investment in my opinion. I would love to hear your thoughts in the comments below. Thank you for your time and attention.